Is Shopify stock undervalued? Now with shares down 80% from record highs. In 2022, Shopify is one of the TSX's worst performing stocks. Since November, Shopify has fallen off because of the sell-off in growth stocks. You are currently reading a free article with views that might not align with those of the Motley Fool's paid investing services. Become a member of the Motley Fool now for immediate access to our best analyst picks, in-depth analysis, investment resources, and more. Study more. One of the biggest online retailers in Canada is Shopify. TSX Shop, NYSE Shop. It is also one of the nation's fastest growing businesses, and it is rapidly extending its market reach to other areas. The stock, however, has taken a significant hit from the ongoing tech crash and is now down 72.18% year on date. In addition, Shop is currently trading over 80% below its 2,228.73 52-week high. Stock split and valuation for Shopify. Shopify announced a stock split in April, taking a lesson from tech behemoths like Amazon, Tesla, and Microsoft. The persistent sell-off surrounding growth stocks has driven Shopify stock much down in recent months, despite the fact that a stock split is seen as a good development. Shop shares are currently selling at astronomically high prices, notwithstanding the negative trend. It is currently selling at a considerable premium to the peer average of 17.68 or 388.30 times its projected non-GAAP earnings. Additionally, Shop's trailing 12-month price-to-cash flow ratio is 149.36, exceeding the 16.39 average for its peer group. However, the stock is priced at a respectable 8.09 times its expected future revenues. Outlook for Shopify's earnings. In the first quarter of its fiscal year, supply chain disruptions and considerable macroeconomic headwinds contributed to a dramatic widening of Shopify's loss margins. Investors were disappointed as it revealed the poorest revenue increase in company history. Additionally, Shopify recorded a loss of $1.47 billion in the first quarter of its fiscal year as opposed to a net profit of $1.26 billion in the same period last year. Its operating cash outflow in the first quarter was $53.56 million as opposed to an inflow of $135.68 million during the same time last year. As interest rates rise in all economies to combat the challenges posed by inflation, this tendency is expected to continue. Furthermore, the earnings picture for Shop appears gloomy as long as the global supply chain constraints continue. The company's EPS is anticipated to drop 88% in the second quarter of the current fiscal year and 85.38% in the current fiscal year 2022. A look at its acquisition of Deliver. Earlier in May, the board of directors of Shopify approved the company's expansion into the logistics sector with the approval of the $2.1 billion purchase of fulfillment technology partner Deliver, Inc. Toby Lutke, CEO of Shopify, stated as follows: "Our goal is to not only level the playing field for independent enterprises, but tilt it in their favor, turning their size and agility into a superpower." Together with Deliver, Shopify Fulfillment Network will provide millions of expanding businesses with access to a straightforward, effective logistics platform that will enable them to continuously please their clients. In the short term, the acquisition is anticipated to impact Shop's profit margins and return on equity. The merger is predicted to have the biggest impact on the company's operating margins in the upcoming fiscal year 2022, but expenditure is anticipated to rise significantly as well. Growth stocks, such as Shop, typically suffer the most in a hawkish environment. Interest rate increases dramatically increase the cost of borrowing for businesses that are growing quickly, reducing their profit margins. Additionally, due to the recent tech sell-off, Shop shares have lost more than 80% of their value since their highs in November 2021, ranking as one of the worst performing Canadian stocks in 2022. However, it also gives investors the chance to purchase a high-quality growth business at a lower multiple. Thank you for watching. Please remember to smash the like button and subscribe to our channel to keep updated on our newest content.